Today is obviously Tesla earnings a day, and I'd actually like to start with a mention of something very interesting about Tesla. Look, a lot of people are putting up earnings estimates, and we'll look at a few of these. What I think is most fascinating, though, is actually positioning. Positioning is probably the most important as well. So there's a piece here by Bank of America Securities, and it talks briefly about Tesla positioning. They start off by talking about tech in a bubble and how high will tech basically go. And the gist of their piece on big tech before we talk about Tesla is really just that, yes, the S&P 500, excluding those top 7 companies in the S&P 500, is valued at just 15 times earnings, but if you factor in those top 7, those top 7 that are trading for 40 times earnings, then the entire S&P valuation goes up to about 18, 19. Point is that a bubble, right? Are these ultra techs a bubble? And the argument by Bank of America Securities ends up that, well, it's really these mega caps or ultra caps at this point that are just deemed the safest to be in, but not only the safest, but they're deemed to be those with the most amount of cash and the most amount of profit potential. So maybe this is more of a case of the rich get richer than it is a case of some kind of a bubble bursting. Now, what is wild about that is actually the very last page of this. Take a look at this. Just Apple and Tesla are underweight out of the 7. So in other words, these funds, larger investment funds or whatever, that have moved into these mega cap stocks so heavily this year so far, are mostly allocated or overweight to Microsoft, Amazon, Google, Nvidia, the other voting class shares of Google, and Facebook, but they're actually underweight Apple and Tesla. Now, that I think is very interesting because this could lead to floors under, and this is my thesis, but could lead to floors under pricing for Apple and Tesla. In other words, weak earnings at Apple and Tesla could be seen as a short-term opportunity to get back to overweight in these 2 stocks to catch up to the investments being made into the Microsoft, Amazon, Google, Nvidia, and Facebook. That's a thesis that I have. We're not necessarily always going to be able to say that, bad earnings is always going to get caught up with dip buying, but it does seem to be that there's a lot of money on the sidelines, whether it's from fund managers or individual retail looking for an opportunity to buy the dip. Usually, Tesla earnings lead Tesla stock to go negative. And I do think it's very interesting that on the morning of Tesla earnings, you have Tesla actually trading up about 0.7% in pre-market trading, especially since usually Tesla goes negative after earnings. So pay attention to that. But this underweight positioning by institutions of Tesla and Apple could be a good tailwind for Tesla and Apple. I'm honestly surprised that Apple was somewhat underweight as well relative to some of these others here. But, oh well. and it's also worth noting the number of funds, not just the positioning of underweight versus overweight, but also the actual positioning. If you do own Apple, or rather I should say, not relative to the being underweight, overweight. Let me rephrase that. Somewhere still around 70% of funds do have exposure to Apple, but it's a nominal exposure. So that's what's worth noting is the level of exposure for Apple is high. Like a lot of people have a little bit of Apple, but it's underweight compared to even the S&P 500. As you can see, Apple positioning is only sitting at about 0.6, whereas the S&P 500 would put you at a substantially higher positioning. And funds actually have a higher positioning to Microsoft, Amazon, Google, Nvidia, Meta than they do to the S&P 500. But only about somewhere 32-ish, 35-ish% of funds actually have exposure to Tesla. It's all alone over there in that corner. Wild. Now, regarding some estimates, I'd love to see Troy's estimates on Twitter. I think he does a great job. His estimates here versus consensus are that we're looking for an 80-cent non-GAAP EPS. I personally don't love using non-GAAP. Let me just quickly remind you what non-GAAP is. Non-GAAP is, and every company is different with this, so I'm painting with a big brush here, but non-GAAP is basically a beautiful way to say, hey, stock-based comp is a non-cash expense, so we're going to pretend like we didn't spend any stock-based compensation money. So if we say we spent $200 million on stock-based comp, we're just going to come up with this new figure called non-GAAP EPS that won't be associated with our stock-based comp and evaluate based on that, which I think clearly understates your compensation expenses. This is why usually your GAAP EPS is lower. So to be exact, the adjusted or non-GAAP EPS for Tesla is expected to be 80.9% to be perfect. Tesla has beat on that number 5 out of 8 of the last earnings. For EPS GAAP, we're looking for 71.1 cents. They've beaten on that number 6 out of 8 times. On revenue, Tesla has beat 5 out of 8 times. We're looking for $24.5 billion. And on net income, they've beaten 7 out of 8 times, which is good that you have this history of beating sort of on a margin POV. And we're looking for $2.87 billion. So I would write those numbers down. I also think it's interesting that the average movement for Tesla stock is 7.14%, but the implied movement over the next 24 hours is only 6.48%, which is lower than what you would have expected. So let's go back for a moment to Troy's calc. So we got some more detail here on the Wall Street consensus. His thinking is that Wall Street's margin estimate is going to be 18.2. He thinks they're actually going to come in with a 17.3. I do think the big two risks for Tesla are not only you getting this margin miss from Wall Street expectations, because that, unfortunately, that a margin miss is going to lead to future write-downs of earnings. Not great. But that could be offset by what's said in the earnings call, so it's always possible that the first minute you get some kind of large sell-off, and then maybe that gets talked up again in the earnings call. Though I don't know. Usually I'm not so knock on wood optimistic about post earnings, but I've never really found Tesla or trading earnings to be super beneficial since. Sometimes you end up getting to a 3-week rally soon after you get earnings, and then all of a sudden you miss out because you're like, oh crap, I forgot to buy back in. Trading earnings is really difficult, so I'm not selling. So what else do we have? We've got Nissan announced they're adopting the Tesla charging adapter as well. You've got a little bit of news that Tesla is converting a movie theater, I think it was in LA, into some kind of delivery and service center hub, which is great because the more service centers we've got available, the easier it is for new customers to get their problems dealt with. Personally, I haven't had a lot of problems with the Teslas lately, but I will say when I first got my Tesla back in 2017, there were a lot of problems, and having more service centers around is nice, especially when you have the mobile service centers. Some areas just don't have mobile service availability, so the more they can expand that service, the more people can say nice and positive things about Tesla. So overall, look, whatever happens today for Tesla earnings, obviously, it's going to be very closely watched. I'll be covering it live, so make sure you're there. But this underweight right here, buy funds for Tesla, could flip. And this is where I actually like to go most optimistic. And I realize it's probably a little biased, but I want to put it this way. I think that once Tesla, and I'm going to write this down because I didn't want it to be forgotten. Once Tesla proves it can survive this recession, which I know most of us who invest in Tesla are looking at this going, what do you mean, Kevin? Of course they're going to survive this recession. Yes, we know that. But once Tesla proves to the rest of these underweight funds, so I'm going to write this, to the underweight funds, that not only can it survive this recession, but also still generate incredible above industry average margins and beyond, because really industry margins suck anyway, right? Margins suck anyway, though. I like to say that industry margins suck anyway. I mean, GM's decent, except for their EV business. They lose money on EVs. They don't expect to make money on electric vehicles until like 2025. But for their legacy biz, they're somewhere around 13% gross profit. And, Ford is a little less than that, but still decent, excluding electric vehicles. They don't expect to make money on electric vehicles until 26 or something stupid like that. But anywho, once I believe that Tesla proves, look, we're going to get through the hard time. We're going to get through the potential, we're going to survive the capital needs, right? This is stock, this is basically a money raise. And survive the margin, or I should say hit the margin trough, which is hitting the floor, right? And then we start moving up again and move up again. This is really when I think you're going to start getting those underweight funds actually moving into Tesla. So a lot of people have been wondering, like, hey, when would I really in earnest be interested in, not just like from a rebalance point of view, but cutting Tesla and selling Tesla and moving into whether it's real estate or something else? Well, it's really when funds get euphoric. That's when trim time comes. And we're nowhere close to that. So I know the stock has obviously moved from 105 or whatever to 290s, but really that just puts you back to where you were in March of last year. So you really haven't done anything if you look at it from a year-over-year point of view. So euphoria wasn't there then. It isn't here now. And in my opinion, that actually gives you a floor for bad news, as much as there could be a little rubber band to the downside, but it gives you a really optimistic path forward. Those are my takes. Now, we'll see. We'll see what ends up happening. Tesla should just acquire Enphase. They probably wouldn't do that mostly because they create their own inverters. And they use string inverters, which are a cheaper way of conducting solar installs. The microinverter people say that, so that's a little biased. But it's very unlikely that you would see that when they acquired Solar City, right? So you're acquiring the string inverter Strat, which is okay. At what point is Tesla overpriced? That's going to depend on where that trough in margin is and where the trajectory is of where it ends up going. So, if Tesla caps out at a 20% margin, maybe euphoric is 350, 375. If Tesla goes back to its 30% margin direction, maybe euphoric is more like $500, $600. Who knows? It could even be much higher than that. So we'll have to see. Anyway, some thoughts on Tesla. So buckle up today. But this underweight positioning, something I haven't seen talked about, and makes me very excited. So we'll see. Because the more you get institutions transitioning, the more you actually get positive analyst pieces written as well, as opposed to all the bear pieces that get written about FSD and all that nonsense, which you really have to drive FSD to understand it. Somebody has negative comments about FSD and they haven't actually tried it. Probably not the best resource to consider opinions from. Anywho, as always, remember to check out the programs on Building Your Wealth link down below. Next coupon expiration is a week from today for Fed Day. And as always, not only do we always add more content, but we do fundy analysis every single day the market is open on stocks that you're looking at, or I'm looking at, or earnings calls, or whatever. Really great for looking for value opportunities or understanding how the market functions, learning about where opportunities are, and much more. Not only that, but then, of course, we've got the real estate analysis, and one of the most popular ones right now, how to make more money and get SH9T done faster, featuring AI to really get you from zero to, oh wow, I can actually use AI productively on a daily basis.
Now, I want you to know this, when it comes to AI, time is what's going to make you money. And if you can prove that value to an employer, you'll always be able to be employed. So this is another way of making sure that you don't get replaced by